You have probably lost money in places where the market looked most obvious. That is the part worth examining, not the bad entry alone, not the stop that was too tight. The real cost is quieter than that. It is the habit of stepping into the market at the exact point where patient traders are waiting for impatient traders to reveal themselves. A chart can look inviting for the wrong reason. A breakout can look clean because late buyers are being drawn in. A sharp sell-off can look dangerous because weak holders are being forced out. Price does not only move because traders agree on direction. Very often, it moves because one group has run out of patience, another group has run out of margin, and a better, informed group is waiting for that pressure to finish its work. This is where the difference begins. The professional is not interested in every movement. He does not need to be first. He is not paid for activity, and he does not confuse motion with opportunity. He studies where the market is likely to create urgency. Where will buyers chase? Where will sellers panic? Where are stops collected? Where does the crowd become so certain that it stops protecting itself? When you trade from excitement, you usually enter where the auction is already emotional. You see a candle expand and feel that delay will cost you. You see price approaching a level and decide that being early is safer than being late. But the market has a way of charging a fee for that kind of urgency. It gives you a quick confirmation, then asks whether your decision was based on evidence or discomfort. The zones where the pros wait are rarely comfortable at first glance. They are not always marked by perfect patterns or clean signals. They are areas where behavior changes. Volume may expand, but progress slows. Price may break a level and fail to hold it. A trend may look strong, yet each new push begins to attract less follow-through. These details matter because they show you not only where price is, but who is becoming trapped there. A trader must learn to read this without hurry. Do not ask only, is this bullish or bearish? That question is too small. Ask what the current move is forcing other traders to do. Are late buyers being rewarded, or are they being used for liquidity? Are sellers pressing into weakness, or are they selling into the hands of stronger demand? Is the market accepting a new price area, or only reaching into it to find orders? This kind of thinking changes your relationship with the chart. You stop treating every candle as an instruction. You begin to see price as a negotiation between urgency and patience. The less experienced trader reacts to the visible move. The more disciplined trader studies the conditions that made the move necessary. And this is why waiting is not passivity. Waiting is work, provided you know what you are waiting for. You watch how price behaves near obvious highs and lows. You notice whether a breakout attracts continuation or rejection. You avoid entering merely because the market has moved far enough to stir your emotions. You begin to understand that the best trades often appear after the crowd has already made its decision. The first difficulty is not finding the zone. The first difficulty is standing near it without doing anything. You can mark the area correctly, understand why it matters, and still lose control before the market gives you enough reason to act. That is an uncomfortable truth, because it means the problem is not always ignorance. Sometimes the problem is that you knew enough to wait, but not enough about yourself to remain still. The market has a way of making patience feel like weakness. Price moves toward your area, slows for a moment, then moves away just enough to make you question your plan. You begin to think that a careful trader is becoming a late trader. The mind starts to bargain. It says, this is close enough. It says, if I wait longer, the trade may leave without me. And when that thought takes hold, you are no longer reading the market with a clear eye. You are trying to escape the discomfort of not knowing. That discomfort is powerful because it feels practical. It does not announce itself as fear. It disguises itself as decisiveness. You tell yourself you are being proactive, that you are anticipating, that you are trading with confidence. But confidence that appears only when patience becomes painful is not confidence. It is relief-seeking. And the market is very skilled at drawing relief seekers into poor positions. A professional zone is rarely comfortable before it proves itself. If it were comfortable, everyone would wait for it properly. The difficulty is part of its value. before the better opportunity appears, there is often uncertainty, delay, and the feeling that nothing clean is happening. This is where inexperienced traders begin to act simply to end the waiting. They would rather be wrong in a trade than uncertain outside of one. That is a costly preference. You must understand what is happening inside you at that moment. The chart has not yet changed enough to justify action, but your emotions have. That difference matters. When the trader changes faster than the market, the decision becomes suspect. The market may be approaching an important area, but if your reason for acting is pressure, impatience, or fear of missing out, then the zone is no longer guiding you. Your discomfort is. This is why waiting is not an empty discipline. It is a test of whether your plan has authority over your mood. A trader who cannot wait near a level will usually pay for early certainty. He enters before the market has shown its hand, and because he entered to relieve tension, he now needs the market to reward him quickly. If price hesitates, he becomes vulnerable. If price moves against him, he feels betrayed. But the betrayal did not begin with the market. It began when he treated discomfort as information. There is a quiet strength in allowing the market to remain undecided. You do not need to predict every movement inside the zone. You do not need to answer every flicker of price with a decision. Your task is to notice when your desire to act becomes stronger than the evidence in front of you. That is the point where many trades begin to rot before they are even placed. So when price approaches the area you have been watching, pay attention to your own urgency. Are you afraid the trade will leave without you? Are you trying to get in early so you can feel clever? Are you lowering your standards because the market is close to where you wanted it to be? These questions are not meant to make you timid. They are meant to keep you honest. The trader who waits properly is not waiting because he is passive. He is waiting because he refuses to let discomfort set the price of his decision. He knows that the market will always offer movement, but it will not always offer clarity. And before we can speak about entering the zone correctly, you must first understand this. The first battle at the professional level is not against price, but against the need to act before price has earned your trust. Seeing the zone is not the same as trading it. This is where many good ideas become poor positions. A trader marks the area, waits for price to arrive, and then acts as though arrival itself is confirmation. But the market does not owe you a trade simply because it has reached the place you are watching. A zone is only a location. Execution is the test of what price does when it gets there. The distinction is important. Location tells you where attention may be justified. Execution tells you whether commitment is justified. If you enter only because price has touched your level, you are not executing a plan. You are assuming the level will do the work for you. The professional does not treat a zone as a button to press. He treats it as a place to observe. When price enters the area, he watches the quality of the reaction. Does the move slow? Does price reject the area and fail to return? Does it test deeper and still refuse to continue? Does the market show that opposing pressure is beginning to matter? These details are not decoration. They are the difference between an idea and a trade. Execution requires sequence. First, price must come to the area. Second, it must show behavior that supports the idea. Third, the trader must enter at a point where the trade can still be controlled. If one of those parts is missing, the execution is incomplete. A rushed entry may be near the right zone but still be wrong in timing. A late entry may have confirmation but poor control. A clean execution respects both the location and the moment. This is why you must be careful with the first reaction. The first touch of a zone often creates noise. Price may bounce because short-term traders are taking profits. It may pause because orders are being processed. It may spike because emotion is still running through the market. None of that is enough by itself. You are not looking for movement alone. You are looking for a change in behavior that gives your idea a reason to exist. The better execution often comes after the market has made its first statement. Price enters the zone, reacts, and then gives you information through its next attempt. If it returns and cannot push through with authority, that tells you something. If it rejects and holds away from the area, that tells you something else. The trader who waits for this evidence is not trying to be perfect. He is trying to avoid paying for guesses that look like decisions. You should also know where the idea is wrong before you enter. Not because this section is about loss, but because execution without invalidation is vague. If the market does the one thing that proves your read has failed, you must know it in advance. Otherwise, every movement against you becomes something to explain away. A good entry is not just a place to get in. It is a place where the market can quickly show whether your judgment belongs there. Do not enter because the candle looks dramatic. Do not enter because the zone has been touched. Do not enter because you are afraid the move will start without you. Wait for the market to give a reason that is visible, repeatable, and connected to the area you planned. The action must come from evidence, not from the fact that price is nearby. This is the discipline of execution. You let the zone bring your attention, but you let behavior earn your order. One without the other is incomplete. A location without behavior is only a possibility. Behavior without location is often too late. The trader's work is to bring them together at a point where the decision is clear enough to act on. And yet even a clean execution is not enough by itself. The next question is quieter, but just as unforgiving. After you have found the zone and entered it correctly, does the trade still deserve the risk it asks you to take? A trade can be right in direction and still be wrong in construction. That is one of the harder lessons, because the market may even reward the idea for a while. Price moves from the zone. The red appears sound, and yet the result does not justify the risk. This is where a trader learns that being correct is not the same as being paid well. The market does not pay you for identifying a promising area. It pays you according to the relationship between what you risk and what the move can reasonably give. If the stop must be wide, the target is near, or the entry comes after much of the move has already occurred, the trade may have little mathematical strength left. The idea may still be intelligent, but the opportunity has become thin. This is why the professional thinks in terms of asymmetry. He is not asking only, can this move in my favor? He is asking, is the possible gain large enough compared with the necessary risk? That question changes the quality of the decision. It prevents a trader from accepting a poor bargain simply because the chart looks agreeable. A good zone should offer a place where the risk can be defined with discipline. If the market must move too far against you before your idea is proven wrong, then the trade asks for too much room. If the next opposing area is close, then the reward may be too limited. In both cases, the trade may feel reasonable, but the numbers are warning you that the price of participation is high. This is where traders quietly damage their results. They take trades that require a large loss to discover they are wrong, but offer only a modest gain if they are right. One such trade may not seem dangerous. A series of them changes the account. The trader begins needing a high win rate just to remain even. Then one ordinary mistake carries more weight than several small successes. The problem was not only the losing trade. The problem was accepting bad terms before the trade began. You must learn to measure the trade before you admire it. Where is the point that proves the idea has failed? Where is the first area where price is likely to meet opposition? How much room lies between those 2 points? If that distance is not favorable, the trade does not become better because the setup looks clean. Mathematics does not care how persuasive a pattern appears. This does not mean every trade must promise a large move. It means the reward must be honest relative to the risk. A smaller target can be acceptable when the risk is smaller still. A larger target can be meaningless if the position must survive too much disorder to reach it. The balance matters. Without that balance, the trader is no longer choosing opportunity. He is buying exposure. The professional zone has value because it can offer a point of control. Price is near an area where the idea can be tested. If the market responds properly, the trader may gain access to a move while risking only a measured amount. That is the attraction. Not certainty, not prediction. Control. The best locations allow the trader to be wrong without being badly damaged, and right without being underpaid. So before you call a trade good, let the numbers speak. Do not ask only whether the setup is attractive. Ask whether the market is offering you a fair exchange. If you must risk too much for too little, step aside. If the move has already traveled too far from the place where risk was clean, do not chase the remains of the idea. There is discipline in refusing a trade that is correct but poorly priced, and once you begin to see trades this way, the chart changes. Certain areas stop being mere support or resistance. Price often moves hardest after it has passed through the place where everyone thought it should stop. That is not an accident. The market is not only searching for direction, it is searching for orders. Before a real move can develop, there must be enough buying or selling available for larger participants to do business. This is why the most important zones are often found near the most obvious places on the chart: prior highs, prior lows, clean ranges, breakout points, and levels where traders have placed their protection. These areas attract attention because they are easy to see. A high invites breakout buyers. A low invites breakdown sellers. A range boundary invites both defenders and attackers. Stops gather beyond these points because traders need a place to admit they are wrong. Entry orders gather there because other traders want confirmation. The result is a pocket of liquidity. To the untrained eye, it looks like a simple level. To a more informed trader, it is a place where decisions are waiting to be forced. The market often reaches into these areas because that is where activity can be found. If price pushes above an obvious high, it may trigger buy stops from traders who were short and breakout orders from traders who want to be long. That buying provides fuel. But fuel does not always mean continuation. Sometimes it gives stronger sellers the liquidity they need. The same is true below a visible low. A break lower may trigger panic selling and protective stops, only to find stronger demand waiting on the other side. This is the behavior you must learn to read. The break itself is not the whole message. The question is what happens after the orders are triggered. Does price continue with acceptance, or does it fail once the trapped traders have been pulled in? Does the market hold beyond the level, or does it return quickly back inside the prior area? A level is tested by what follows the breach, not by the breach alone. This is why professional zones often sit where the crowd becomes exposed. A trader who buys a breakout is exposed if price falls back under the level. A trader who sells a breakdown is exposed if price recovers quickly. Once trapped, these traders become future order flow. Their exits can help drive the move in the opposite direction. The market does not need their opinion anymore. It only needs their orders. You should begin looking at the chart in terms of pressure, not lines. Where are traders likely to be wrong if price reverses? Where are stops likely resting because the level looks safe? Where would a breakout attract late participation? Where would a quick failure create urgency? These questions reveal the structure beneath the visible pattern. A strong zone is not strong because it is clean. It is strong because it sits near a place where other traders must act. When price enters that area, the market is testing commitment. If new buyers appear and price holds, the auction may be accepting higher prices. If buyers appear and price immediately rejects, the buying may have served only as liquidity for sellers. The same logic applies in reverse near lows. This does not mean every sweep becomes a reversal or every breakout becomes a trap. That would be too simple. The lesson is more precise. Do not treat a visible level as the decision itself. Treat it as a place where the market may reveal who is trapped, who is committed, and who has the power to move price after the first wave of orders is spent. When you understand liquidity, you stop being impressed by the first break. You watch the reaction after the break. You notice whether price finds acceptance or rejection. You study whether trapped traders are being created, released, or forced to chase. The market becomes less mysterious when you see that movement often begins where one group's protection becomes another group's opportunity. But even when you recognize where the orders are gathered, there remains a harder question: should you participate, or should you leave the trade alone? A professional zone does not command you to trade. It invites judgment. That distinction is easy to miss. Once you have marked the area, watched price approach it, and understood why it matters, the mind wants a decision. It wants the work to become action. but a serious trader must accept a colder truth. Some of the best decisions happen after a valid setup appears and the trader still does nothing. The market will often bring you close to a good idea under poor conditions. The level may be clear, but the surrounding context may be dull. The reaction may be present, but not convincing. The distance to the next obstacle may be narrow. The broader session may be thin, disorderly, or distorted by scheduled news. When these conditions appear, the question is not whether the zone has meaning. The question is whether the trade is clean enough to deserve involvement. This is where decision-making separates itself from analysis. Analysis can tell you what might happen. Decision-making decides whether that possibility is worth your capital. A trader who cannot separate those two will trade every idea he understands. He sees a reason, then assumes a trade must follow. But markets are full of reasons. Reasons are common. Clean decisions are rare. You must learn to reject the marginal trade before it becomes a problem. A marginal trade is not always ugly. Often it is almost good. It has a level, a reaction, a story, and enough evidence to tempt you. But one part of it is weak. Perhaps the move is crowded. Perhaps the timing is late. Perhaps the market is moving without rhythm. Perhaps your target area is too near. Each weakness by itself may seem small, but small weaknesses combine into unclear risk. The danger of the marginal trade is that it consumes attention out of proportion to its quality. Once you are in, you must watch it, explain it, defend it, and manage the uncertainty it creates. A trade that should never have been taken becomes a mental tenant in your day. It occupies space that could have been reserved for a clearer opportunity. This is how traders become busy without becoming effective. A professional decision is often subtractive. It removes trades. It says no to the setup that is incomplete, no to the idea that depends on too many favorable assumptions, no to the entry that requires the market to behave perfectly. This kind of refusal is not fear. It is selection. The trader is not trying to avoid risk altogether. He is trying to avoid risk that has not earned its place. You can apply this by asking a stricter set of questions before involvement. Is the context aligned, or am I isolating one attractive detail? Has the market given enough evidence, or am I filling in the missing parts myself? Is there enough room for the trade to work before it meets opposition? Is the session clean enough to trust the movement? Would I still take this trade if I had not been watching it for the last hour? That last question matters. The longer you watch a market, the easier it becomes to feel invested before you are actually in a position. Time spent observing can create attachment. Attachment can lower standards. And once standards fall, the trader begins to confuse familiarity with quality. So the decision must be made with detachment. The zone may be important. The idea may be intelligent. The movement may be interesting. None of that is enough. The trade must pass the filter as it stands now, not as you hoped it would look when you first marked it. When you refuse a weak trade, you are not missing out. You are preserving clarity. You are keeping your capital available, your attention clean, and your judgment unburdened. This is why the trade you do not take is part of the strategy. It shapes the quality of every trade that remains. The calmest trader at the active price is usually the one who did the most work before price arrived. That is not because he knows what the market will do. He does not. His advantage is that he has already reduced the number of decisions that must be made under pressure. When the market is moving quickly, he is not trying to invent a plan. He is comparing what is happening against a plan already prepared. This is one of the quiet habits that separates professional behavior from ordinary reaction. The professional does not begin his thinking when the candle reaches the level. He begins earlier, when the market is still away from the zone and his judgment is not being pushed by movement. He marks the areas that matter, not so he can predict them perfectly, but so he can meet price with a prepared mind. Before the market reaches the zone, he asks what the area represents. Is it a place where prior demand appeared? Is it a place where supply stopped an advance? Is it a point where traders are likely to change their behavior if price tests it again? He is not drawing lines for decoration. He is identifying places where the market may reveal intent. Then he prepares scenarios. If price reaches the zone calmly, that may suggest one kind of response. If it arrives with speed, that may suggest another. If it cuts through the area and immediately returns, that must be treated differently from a slow, steady acceptance beyond it. By preparing these possibilities in advance, the trader avoids being surprised by ordinary market behavior. This habit matters because an unprepared trader becomes dependent on the moment. He must decide while price is moving, while candles are expanding, while the screen is offering new information faster than he can organize it. Because he has no prior framework, every movement feels important. He reacts to the latest print instead of judging the whole condition. The professional habit is to define what would matter before it happens. What would make this zone worth attention? What would make it unimportant? What would show that the market is only passing through? What would show that the area is beginning to influence behavior? These questions are not predictions. They are boundaries for interpretation. A trader should also know what he will not do near the zone. He will not trade simply because price has arrived. He will not change the meaning of the area after the fact to justify involvement. He will not expand the zone endlessly because the first idea failed. These rules protect the plan from becoming flexible in the wrong way. A plan must adapt to evidence, but it must not bend to convenience. Preparation also includes knowing the surrounding condition. A zone does not exist in isolation. The time of day, the speed of the approach, the recent range, and the broader direction can all affect how much attention the area deserves. The professional notes these things beforehand because context becomes harder to weigh once the market is already pressing the level. You can practice this by making your plan plain before the trade exists. Mark the zone. Write the reason it matters in one sentence. Define what behavior would confirm that the market respects the area. Define what behavior would make you ignore it. Decide where the idea is no longer valid. The simpler the preparation, the harder it is to deceive yourself later. This is not busy work. It is how a trader removes confusion before confusion has a chance to become expensive. When the market finally reaches the area, he is not asking, "What do I feel like doing?" He is asking, "Which of my prepared scenarios is unfolding?" That shift alone changes the quality of his conduct. The public often sees patience at the moment of action and thinks it is temperament. More often, it is preparation. The trader appears composed because he has already rehearsed the market's possible answers. He has already decided what deserves attention and what deserves to be ignored. But preparation only brings you to the edge of the decision. Once the market responds and a position is taken, another discipline begins: the ability to manage what is now real without allowing the original plan to decay under profit, pressure, or doubt. A trade can begin well and still be handled poorly. This is one of the quieter ways traders give money back to the market. The entry is clean. The zone responds. Price moves in the intended direction. For a moment, everything appears orderly. Then the trader forgets that a live position is not a finished judgment. It is a condition that must be managed while the market continues to speak. Once you are in the trade, your task changes. Before entry, you were deciding whether the market had given enough reason to participate. After entry, you are judging whether the market continues to support that decision. This distinction matters because the original reason for the trade can weaken, strengthen, or disappear altogether. A trader who does not notice the change will manage the position from memory instead of evidence. The first thing to observe is whether the response from the zone has real follow-through. A proper reaction should not only move away from the area, it should begin to show control. If price leaves the zone but immediately stalls, rotates, and returns with ease, the market is telling you the response may be shallow. If price moves away and begins holding above or below fresh levels, the trade has gained structure. Management begins with that reading. You should not rush to interfere with a trade simply because it shows profit. Small profit is not always protection. Sometimes the market needs room to develop. If you tighten too early, you can turn a good idea into a nervous exit. But if you never reduce risk when the market has clearly moved in your favor, you allow a working trade to remain exposed longer than necessary. The skill is not in always moving the stop or never moving it. The skill is in knowing what the market has earned. A stop should not be moved because you want comfort. It should be moved because the market has created a new area that should not be violated if the trade is still healthy. That is an important difference. Comfort-based management reacts to account movement. Structure-based management reacts to price behavior. One is centered on the trader. The other is centered on the trade. The same discipline applies to taking profit. Do not exit merely because the position has become pleasant to look at. Do not hold merely because you want the move to become exceptional. A trade from a professional zone should be managed by how price behaves as it approaches areas of potential resistance or support. If momentum weakens, progress slows, and rejection begins to appear, the market may be warning that the easy part of the move has passed. If price absorbs opposition and continues to hold, cutting the trade too soon may be the greater mistake. Scaling requires even more restraint. Adding to a position is not a reward for being right. It is a new decision. The market must give a fresh reason for additional risk,